Hi, I'm Certified Financial Planner Kathleen Nemetz. Welcome to our show, Women on Money. This is a collaborative effort with our guest today. Meet Tamara Hall, CPA and partner in Delahanty, Janice Hall CPAs. Georgeana Roussos, Social Security attorney. I am today's moderator. Welcome, ladies.
Thank you. Thank you.
It's the largest social welfare program in the United States. It accounts for more than 21% of federal government spending. I'm describing Social Security, helping support more than 67 million people of our country's estimated 329 million population. About 47 million of these recipients are people aged 65 or older. The group that the program was actually conceived for in 1935. The rest are people who qualify for reasons other than old age. Let's first explore what's new for 2018. Tamara, do you want to take that away?
So not much is new. The new tax bill that came into play at the end of 2017 didn't really change much in the Social Security benefits. Certainly nothing really changed there other than the COLA, the
Cost of living adjustment.
I couldn't think what the word was for a second. I used the abbreviation too much. Is only 2%, but that's been consistent for the last few years. It hasn't been very high. And then a small increase in what the wage limit is if you're working and contributing.
In other words, if you're working
Yes.
and you're salaried,
Yes.
or if you're self-employed, how much of your income would be subject to Social Security tax?
For 2018, it's $128,400.
Okay. And then beyond that, that income is not counted for Social Security.
Not for Social Security. It is for Medicare, though.
Okay, that's
There is
an
no
important
limit on
distinction.
Medicare. Yes.
Generally, what are the eligibility criteria for Social Security benefits or Medicare benefits?
Well, basically, you have to have paid taxes over the years, and the amount of money that you'll be receiving as your benefit is going to be determined by the amount of money that you've paid in. Generally speaking, for retirement and Medicare coverage, it's 40 quarters. Another factor that influences how much you're going to be paid is when are you going to collect these benefits as regards retirement benefits. It actually makes a huge difference, and it's interesting to me how few people really realize that. If you collect your benefits before your full retirement age, which for anyone born in 1960 and thereafter is going to be 67, and for people who were born prior to that, it depends upon, it'll be sometime between 66, depending upon when you were born, in 67, you could generate a boon in a way if you waited, if you stalled on collecting.
It's an 8% increase per year after age 66.
After your full after your full retirement age, that's 8%, and so you know that the minimum difference is going to be at least a quarter more per month if you were born in 1960 thereafter. If you decide to work until you're 70, that's the magic age. And so,
whereas if you claim benefits at age 62, you can be penalized, and
significantly.
And that discount to your benefit stays with you until you die.
Exactly, for the rest of your days. For every month that you collect early, there's a small penalty that is cumulative. It applies and it never goes away.
Now we're just talk a little bit about disability.
Yeah,
that plays a role.
I think so. I mean, I think that it's an very important program that I think needs to be prioritized. For individuals who are unable to work or expected to be unable to work for at least 12 straight months, or if they have a terminal illness, they are potentially eligible to receive Social Security disability benefits, which again are based on their earnings history. The reason why it's particularly important as regards people who are older is that they may qualify for disability benefits and then not need to take their retirement benefits early, and then they avoid that penalty of taking your retirement benefits early. It's not easy to establish disability. It takes a long time. You have to be prepared, and you have to be seeing doctors, and you have to have medical evidence to back it up.
In setting the foundation for this discussion, it's important that a lot of our viewers are women, and they may be claiming on the record of their spouse, either their current spouse, they're currently married, or perhaps they're divorced, perhaps they're widowed. So for each one of these categories of people, there's going to be differences in how to optimize that claiming strategy, and about even the differences in vocabulary. When you're speaking to Social Security and you're asking questions about a survivor's benefit or a spousal benefit or a death benefit, and each set of these terms has very significant differences in their application. And if you use the wrong term, you can get the wrong answer. And it's sometimes very frustrating because I might send the person back several times to Social Security to talk about the same matter. And I know you deal with clients who are having this problem as well.
It's a frustrating problem for people, and it actually has significant consequences because if you're applying for spousal benefits, in other words, benefits on the record of a person that you are or were married to, when you apply for those benefits, if you don't state exactly what you want the first time around, with the new rules that have been passed, you're going to be deemed to have been applying for your own retirement benefit and your spousal benefit, and then it's going to lock you out of that possibility of potentially waiting to age 70 and letting your benefit ride, if in fact that's a smart thing for you to do. You know, everything depends upon the individual circumstances. So it's very significant. Death benefit, people think that refers commonly to widows or widowers' benefits, but no, actually it's a small stipend it doesn't even cover the cost of a cremation urn.
It's $250,
it's a very small amount of money. But that's what that refers to, and then the survivor benefits are for those individuals who were married to someone who passed away.
Now, in this discussion, it's important to note what the current average benefit is nationally. And that's not to say that this would be the benefit of anybody watching the program if they're claiming in the future. And it also is a reflection that a lot of people do claim early and they claim a discounted benefit. So the current national average on a monthly basis is about $1,339 a month, which is about $16,000 to $17,000 a year. And I frankly find it hard to think that somebody could live on that, but people apparently do. But the reality is people need alternate sources of income, and even that benefit, as modest as it is, can be taxed depending on what people are doing aside from collecting their Social Security. Tamara, do you want to talk a little bit about the effect of tax on Social Security?
The biggest issue is that if you're under 70, your Social Security benefits could be taxable. If you're 70, they're not. You can earn as much money as you want in all the different areas that you can earn money, and your Social Security benefits will not be taxable. So you have that double benefit of waiting until you're 70 to get the maximum benefit and then also not being taxed on it, which is a great win-win. But if you're under 70 and you start taking your Social Security benefits, if you continue to work, then you're subjecting those benefits to 85% of them can be taxable. So you think of it as something you've earned, and I hear this all the time from clients, well, I paid for that. Yeah, unfortunately you did, but the rule is if you're collecting it under age 70 and you're also still working, 85% is usually taxable.
And it's not to say that 85% of the money goes back to the government. It means that 85% of the money is levied as if it was normal income. So if your normal tax bracket is 15 to 20 to 25%, that much money would be going back to the government, state and federal.
Right, and it's possible. I mean, one of the things that did change in the tax law at the end of 17 is that the standard deduction was increased. So it's possible that we're going to see more people who are lower income and maybe, they don't have much income outside of Social Security ending up with no taxable income after the standard deduction is deducted. So and you still have that with people with, if they have large itemized deductions. So they end up not paying any tax on it, but they're not happy to see that it's taxable on that first page of their tax return.
So depending on how people are earning their income during their working years, then of course they're accumulating these credits toward an eventual benefit, and that benefit is not only for yourself, It helps pay a benefit to your spouse if you pass away. For men or women who are divorced and they've been married for 10 years, they could collect a benefit based on a spouse's record of history, working history. But also if you pass away, then there's a benefit paid to minor children. So these are all considerations to make in structuring how you take income, how you declare income, what income you pay tax on. And for instance, there are situations that arise with self-employment and how people who perhaps work as a couple in the family business make choices about whose income is a salary, whose income might be a draw, and whether there are Social Security credits accumulated for either party. They're self-employed, perhaps managing their own properties, rental properties. They can be in a situation where they're not necessarily paying into Social Security, so it creates issues later in life. Maybe both of you could weigh in on that, because these are important points for people to think about.
I think, and I've seen it and advised several clients on this over the years, where you do have, maybe the husband has the business or the wife has the business, and the other spouse is the supporting partner in whatever role. And so it tends to be that the one who's making the most money and generating the most income for the business is the one who gets the salary. And they think about income tax concerns, but they don't think about that Social Security tax concern. And so I always try to be proactive and say, maybe if you've decided that your gross salary between anybody is $100,000, hypothetically, let's give $80,000 to you and $20,000 to the spouse, so that they're both paying in. Because the net at that point, they're well under the threshold. People talk about, well, you've got that Social Security threshold. It's $128,400. So if that's not a consideration or a factor, allocate it between the two spouses so that they both get something paid in every year.
And I mean, not to be cynical, but if you can allocate it more equitably, that's advantageous, because one never knows what's going to happen.
Exactly.
And one never knows if they're going to be together or not. And it would be a shame if there were a divorce and if the wife, let's say, didn't have any credits, and then if she became disabled, she would have had a benefit potentially that she could have used to support her child if she's living with the child, but that is not going to be available to her if she hasn't had any credits on her account. And so, and also, her retirement amount is going to be less if it's not an equitable distribution. So, in the moment, sometimes it feels like, oh, this is the smart money thing to do. I'm lowering my taxes. And we're not paying as much in taxes, but actually sometimes you could be shortchanging yourself and those you love.
So if people are compensated with straight commissions, and they're essentially self-employed individuals, sometimes they may be tempted not to declare all their income, or can they structure things a little bit differently? Maybe they create a family company and their real estate income is coming through that company, and then they can declare or recognize a salary, and then perhaps you can talk about these different arrangements. Because
I actually have some clients who are like that, who are realtors or real estate brokers, and maybe one spouse is earning the commissions and the other spouse is on the books as some type of admin support or something, because they do tend to do something, and so it's giving them a piece of the commission, income. It's an expense on one Schedule C. The other one has a Schedule C for their share. Maybe they're doing the bookkeeping, the record keeping, etc. And so it is allocating it. It is interesting to see the dynamics of a relationship and how much is given to, to the spouse. But I do think I strongly encourage that. If you're not doing an actual salary and a W-2 and payroll, and you are, self-employed and doing a Schedule C, if you can allocate some of it out to the spouse, I think it's definitely benefit, because
a lot of women don't see the issue until it's explained to them, that they think it's saving on current taxes, but they don't think about longer term Social Security benefits for themselves. And of course, if you're a mother and you have minor children, just even having the benefit paid to your children if you suddenly passed away. And this is a supplement to life insurance and all the other things we should be doing for ourselves, of course. But again, it's important to consider, because it's such a useful benefit to have. And we all pay if we all pay into it, we can rely on this.
And I don't think you can overstate the importance of being eligible for Social Security disability insurance benefits. As I said, they're difficult to obtain and they're not a panacea, and it's usually not enough money, but it is coverage, and it carries with it Medicare, and it carries with it also the possibility of auxiliary benefits for children. And so, I mean, it's not just retirement. Somebody might be stricken in their 30s, and you just don't know.
One thing that came up in our previous discussions on this topic was the fact that people who have been divorced, or even like if they're widowed, if the spouse has passed away and their spouse had been previously married, of having proof of marriage or divorce, or if somebody has remarried, having proof of the divorce papers for the previous with the previous spouse. I didn't think about this, but apparently it comes up when you apply for Social Security, and you have to prove, if you're claiming on somebody else's benefit, you have to prove that in fact you were married and for what length of time and what your true status was. And who would have thought? But you want to elaborate a little bit on that
Yeah,
point?
that's definitely true, and it's really sad when people can't do that. And I remember a woman who had been married. Well, she didn't have any paperwork, but they'd been together for over 20 years, and her husband was dying, and she couldn't establish that he had previously divorced his former partner. And so Social Security claimed that it was not a bona fide marriage, that she knew or should have known that it wasn't bona fide. There was no divorce decree. So, and it's just a really sad story because she passed away before it was resolved, but it's just really sad. But
it's just a reminder we all have to be proactive and do our homework and ask questions sometimes that are necessary but uncomfortable, but we absolutely need to protect ourselves.
So you also need to get the Social Security number of the former spouse.
Oh dear.
And you need a copy of the license, and you need a copy of the divorce decree. And date of birth is helpful too. Yeah.
I've even had a client need to provide, location of death and location of birth. Which surprised me. Luckily, that was on the death certificate.
Does it make a difference if somebody was married out of the country? Do they have to provide a translated document?
Oh yeah, those are always fun.
Messages plan ahead, because if you know you might be in one of these categories, have the documents on hand as part of your personal family documents. So let's talk about gotchas. I'm sure we've all seen them. Stupid little things that can save people a lot of trouble if they're planning ahead to maximize their benefit. Anything that comes to mind for you?
It's something that you had discussed is the clients who don't have any self-employment income. They think they've got plenty of cash flow, so they think of it as income, but it's not income that's being taxed for Social Security. And rental income, I think, is a classic example of that. Dividend income, investment income, those things you're not paying self-employment tax on, you're not paying into Social Security. So if you haven't already banked your at least 10 years or 40 quarters, you may not end up being eligible for any benefit of Social Security.
Now you could possibly be still eligible for Medicare, but then you might have to pay the full cost. You wouldn't have a subsidized rate.
Right.
That's correct?
That's my understanding, yes.
Okay. Any gotchas that occur to you?
Well, just lots of little things. I mean, so much of this is statutory. So if, for example, if you would like to claim divorce benefits, that marriage has to be 10 years. So if it's 9 years, 10 months, and you just can't stand the sight of each other, it would make sense, though, to tough it out another 2 months, because it'll make all the difference in the world. Another thing is that if you're ambivalent, if you're older and you're ambivalent about remarrying and you're concerned about your eligibility to collect on the record of a former spouse, wait till you're 60. If you remarry after the age of 60, you'll be able to select upon whose record you will be collecting benefits. And so if you were married many years to a high earner, that could be very important to you. But I think the most important piece of advice is just to be fairly methodical and think expansively. There's income, and then there's also affording security to those in your family. For example, if you have a disabled adult child, someone for whom you can demonstrate that they became disabled before the age of 22, and if that person, has a parent who's collecting retirement benefits, then you can go forward and get a Social Security disability insurance claim for that child. Now, if you weren't declaring and paying taxes on your quarters, you couldn't do that. And so that's a significant advantage. When you have a disabled child, you want to ensure the security of that child.
You won't know in advance if that will happen to you necessarily.
Yes,
you won't know in advance if you will have a child injured, and who would possibly benefit from Social Security because they're harmed and they're not able to work, have a normal life.
Now, that's true.
Yeah. So the other thing I wanted to address is investments. You need to accumulate some savings. So how does one do that? Well, there are IRAs, individual retirement accounts. There's something called a Roth IRA, which is you don't get a tax deduction putting money in, but any assets coming out can be tax-free provided you've held the account for 5 years and you're 59 and a half or older. And that can be hugely beneficial if you're trying to manage your taxation, for instance, with Social Security benefits, taking distributions from taxable retirement accounts, in other words, the required minimum distributions after age 70, and then, of course, your other income. So you start to look for ways to have tax-advantaged income and possibly tax-exempt income, maybe diversifying into municipal bonds. If you're in those magic bracket years of 66 to 70, and you still have some taxation there of your Social Security, you have to be careful where that income's coming from.
Absolutely.
And what the tax nature is.
Yes.
So if you've planned ahead, you forecast what that could be. And that puts more money back into your pocket.
Well, if you're certainly not earning a wage or not doing any self-employment income, and you're trying to also not pull out your Social Security benefit, then, tapping into your investments, your capital gains, hopefully you're in a lower tax bracket. So that would definitely be a better scenario than tapping into Social Security early.
We're nearing the end of our discussion here, but is there one important takeaway you want to leave with our viewers?
I guess it's just, we've said it, but it's that common theme of maximizing your tax deductions is not always the smartest thing to do. You just have to analyze your factors. But it may make more sense to pay more in taxes, but for many years down the line, collect more. 75% of Americans take their retirement early, as you mentioned in the introduction, and they're receiving quite a bit of money, quite a bit less money than they could.
And for me, my takeaway isn't necessarily a tax one. It's a common theme that I keep hearing, and that is if you've been married to somebody for 10 years or more and you're divorced, and maybe you've been divorced for a long time, there's two misconceptions. One is that you have to ask your ex-spouse for permission to tap into their Social Security benefit, and the other is that if you take a Social Security benefit based on their account, you will be reducing their Social Security benefit. And the other one is that if they've remarried, you're not eligible. I've heard that one too. Well, no, they have another wife. It's like all of those are not true. And so, definitely I want people to understand, especially women to understand that, that they're not precluded if any of those things are going on.
And if you're advising your older mother on her eligibility or her benefits, ask these questions. You might help her increase her benefit. The viewer can go to the Social Security
www.ssa.gov.
Thank you. And there are calculators. So you can run your assumptions to see which might be the beneficial way of claiming.
Well, you can set up an account online too and tap into your own actual account and use the calculators using the data that Social Security has on you as well. And you can also look online to see if they have all of your years in there.
That's great. And the wise thing to do, just in case there were years that were not reported.
Yes.
For most people in highly urban areas of the United States, Social Security represents at best a third to one-half of the income they will need in retirement, yet it remains an important source of cash as it pays reliably and for life. Hopefully you have learned some useful strategies to maximize its benefits for you and yours. Thank you for joining us.